Well, what broke first was the long duration stuff. So, particularly with inflation and taking liquidity away, well, the first things that go are the things that are priced for future growth, because you basically lower future growth. As you raise the discount rate, your future expected cash flows are worth less. Now, the issue is, if you have no cash flows, it's worth a lot less. So we find that these long duration things, crypto and growth equities, they got smashed the most. They were the ones that benefited the most. Now, that's not to say, again, we'll go through this in due course, crypto is not correlated in the longer term to any of these things. It's correlated in the liquidity cycle to the liquidity. But if you look at the chart of NASDAQ and crypto over the last 10 years, I mean, they look nothing like each other. So those are the things that get destroyed first. They've already been destroyed. As I said, the long end of growth has priced in about 32 in the ISM, which would be the lowest ISM print since 1974, which when it got down to 30. So it's been very much priced in, the inflation shock, the growth shock. So that's really what's going on there. And then you have to wait around to say, okay, what other shocks are there? Then you start watching credit spreads. If somebody borrowed too much money and they can't pay it back, we haven't really seen a lot of that. Yes, we've seen credit spreads. We've seen Europe having a bit of a struggle, Italy. But the ECB came in as ever and said, we will not allow this to happen. And I kind of believe them. Because when you've got an unlimited balance sheet, you can stop anything happening by buying all the bonds, much like the Japanese do. So where is the big risk? I don't know. I think it's households. It's, everyone's spent all their savings. Everyone's run up credit card debt, and people are going to start losing jobs. And they've lost real earnings because their earnings have gone up, but inflation's gone up more. So the purchasing power of everybody's wages have taken a haircut. We've had terrible negative wages, and that's been a bad shock for people.
Talk a little bit about what ISM is, Raoul, and why it's so important.
So it is my guide to the business cycle. It's what I build my 6-month to 2-year, 18-month framework around. Basically, a general economist will tell you we'll never predict a recession. Why? Because they use linear modeling. They put inputs in, make a few assumptions, linear model. You show a small child a chart of GDP and they go, well, it goes up and down, obviously. Not one fucking economist does this. It's insanity. So back in the late 90s, I started realizing that the business cycle was the predominant driver of asset prices. And just by transposing it to year-on-year S&P versus the ISM, it unveils the whole world. So you know how to make asset allocations once you've learned this simple trick. Again, go to my Twitter feed, have a look at it. There's plenty there. So the ISM survey, as I said earlier, for people who've just joined us, it is the Institute of Supply Management Survey, and we're asking the buyers at all of these giant corporations, industrial companies, what they think of economic conditions, employment, orders, new orders, prices, everything. And it becomes this composite index. And guess what? It goes up and down, just like GDP, but it's like a monthly version of GDP.
Right.
Tends to lead a bit too, because GDP takes a while for accounting.
Right.
So now we've got this monthly variation of this. If you want, you could use the ECRI, and you can get that off the ECRI website, the Economic Cycles Research Institute website. The weekly indicator is a weekly version, very good, works very much like ISM. What you're looking for is turning points at the peak. Then you know that the rate of change of growth is slowing down. However, many people, and I've made this mistake in the past, at peak turning points, you start thinking, well, things are going to slow down. Actually, the rate of change of asset prices still goes on for a long time. When it crosses 50, generally the rate of change of asset prices starts going negative, or if the market starts forecasting that in advance, which is why the S&P is already pricing ISM at 45. 47 is the level that has a 100% guaranteed chance of recession since 1952, whenever the ISM started. It's a long time ago. So it has a perfect track record. And so that's why I use it, because once you start going, you start seeing your forward-looking indicators of ISM, which are usually the subcomponents of ISM, plus other stuff. like freight rates and shipping and car sales and whatever it is, you can start to predict when markets will act in a certain way with more confidence. Nothing is perfect. Things fail, things change. There's other parts of the equation you miss, but it gives you a really much higher probabilistic odds, which is why I'm really comfortable investing in the 6 month to 18-month time horizon versus the 1 week, the 3 months, because I find the economy the best driver. Now, it's also a great arbitrage because almost all the capital in financial markets and all of the models and systems and algos and hedge funds are all working on the intraday to 1 to 3 month time horizons, because that's when they have to report to their investors. Now, if you extend your time horizon by using the business cycle, which is how old school macro used to be, you can generate significant returns over time. But because you're dealing with longer term time horizons, you have to deal with a bit more volatility too. So you need to think about how you size things accordingly. And you get points in the cycle, like we're coming now, where we probably get to an acceleration point in the bond yields if they start falling. And I might really add to that position if I start to see the price go in the favor of what the economy, what the forward-looking indicators, and what the ISM is saying. So to me, it's the single most important indicator for the average person to understand: is the economy growing? Now, it's even if you want to simplify it, you kind of know that when it peaks, probably around 2 years later, you're going to have a recession. And when you get to the bottom, you probably know that in another 2 years' time, 3 years' time, the time horizons aren't perfect, you're going to have a boom. And that just simple tool stops you feeling like you're not in control of what's going on.
That's it for today, guys. If you found this video useful, then don't forget to like the video and share this knowledge with your friends and family. And don't forget to check out the full video, link is in the description. Thank you.